which held its second annual Investor Day today. The stock is jumping as the company outlined the growth potential for the podcast business. Mark Mahaney, Evercore head of Internet Research, was at the event. He joins us now. And Mark, this is still one of your favorite stocks, right? Did you like what you heard today?
Well, it's not one of our top three stocks. This remains in kind of in the speculative growth category, you know, high multiple.
I thought you always loved it.
I have, but I'd prefer to go with the more value growth names now, Amazon,
not for the environment,
Google,
maybe.
And Booking. But that said, Spotify, the key thing that came out of today's event was gross margins. The reason the stock is corrected 60% year to date is in part a sell-off away from this speculative tech growth area, but in part because the company's disappointed investors again in terms of its gross margin outlook for this year. What we learned today are three things. One is that they committed to this year being the peak gross margin drag from all their podcasting investments. Secondly, they gave new disclosure on what's happening in their gross margins in their core music business. It's higher than it's higher than we thought. And then third, they did commit to getting to 30% gross margins over the next 3 years. I think you can kind of count on that. So then now valuation becomes more interesting with the 60% correction in the shares.
Well, I remember the CFO was on last earnings or so, and I asked him like 7 times, are you Netflix? The street is worried about them being the next Netflix in terms of subscriber losses and the stay-at-home reversal trade. Has this company successfully convinced investors that that's not what's happening?
They haven't hit the Netflix wall yet. They could do it, though, but the right numbers to think about are Netflix has, I don't know, 600 to 700 million total number of users, if you count in all the users per account. On an apples-to-apples basis, Spotify is probably more like 400 million. So I don't think that there's any particular reason why they've hit the maturation wall that Netflix has reached. They're also much earlier stage in terms of, but they are further along in terms of generating new revenue streams like advertising. Look, Netflix is now realizing they need to be a freemium business. They need to have both advertising and subscription. Spotify's ahead of them there. So that's actually one of the reasons why I prefer Spotify here to Netflix. I'm not a buyer of Netflix here. They've gone ex-premium growth. Spotify still gives you 20% growth, and you've got a gross margin catalyst. It's next year, and the question is when the market's going to bid that up. May not be till the end of this year that the shares can really start rallying.
Mike Santoli, how does the valuation on Spotify look, which is still more than 60% off its highs?
Yeah, I mean, it's still very much a we're just going to go for growth, and then obviously they have their margin targets, which will make the numbers work better. But based on what it's, cash flows right now and all that, it's not really supporting where the stock trades. And it's not really about that. What's fascinating is, from Spotify's perspective, if you say, are you Netflix? Their answer, if they wanted to actually persuade people that it's worth a bet, is, yeah, we're Netflix in 2015 or something. We're Netflix before everyone assumed Netflix was the category killer and was going to be the dominant core app in streaming. And so therefore, it would have been a great ride until you reached saturation. So to me, you can have it both ways in terms of defining Spotify in terms of Netflix.
Mark Mahaney, thank you for joining us.
Thank you, Sarah.
Good to talk to you.